Happy Friday morning, everybody. Jeff Reber with ERA Heavener Realty. And to get your weekend started right, we're going to talk about saving money on taxes. And so one of my favorite things about paying taxes is figuring out how to save on taxes. And the thing that we're going to talk about this morning is the 1031 exchange. And so it's named for Internal Revenue Code 1031. And what it is you're selling one asset and then immediately taking the proceeds from that sale into another asset, into the same asset class, as it were. So let me give you a hypothetical. Let's say you were smart and you decided to buy a house in 2011 because you thought, the market looks like it's down right now. But then a few years later, you're making more money at your job, you get a relocation, you need to move, and it's 2014, and you look around and you say, 2014 doesn't seem like a good time to sell a house, so I'm going to rent it. So 2011 to 2014, you stayed in the house as your primary residence, and then you moved out. And just for round numbers, in our example here, we're going to use $100,000 as your purchase price. So $100,000 you bought back in 2011. Fast forward to 2019. Now you're looking around and you're thinking, wow, the market's pretty good. My house is worth about twice what I paid for it. So now it's worth $200,000. You're thinking, wow. And again, for round numbers, yes, you would have to pay expenses and commissions, and there would be costs involved with both the buying and the selling, but let's keep our example simple here. So you decide that you're going to sell it, and you've already bought another house, so you don't need the money for your primary residence. You don't necessarily have a place to put the funds, but you want to go ahead and sell this property. You have your reasons. And what you figure out is back in 2014, when you turned it into a rental property, you started depreciating. It's a fancy accounting word there. Started depreciating this property. And again, for round numbers, I think it's going to be about $20,000. And the way that this would work is you take your basis when you moved out, you divide it by 27.5, and then you deduct that annually. I'm not an accountant. Don't ask me to explain that any further. Go ask your accountant if you want an education on how depreciation works. But for our purposes here, that's going to put us in the ballpark. So $100,000 is no longer your basis in the property. Now it's really $80,000. And so now if you sell it, you've got a $120,000 gain that is coming. And let's say you're in a tax bracket that is going to land you in a 25% long-term capital gain tax bracket. And so what's that? 25%, I shouldn't be doing math live, but 25% of 120 is something in the nature of $30,000, right? $30,000 that you are going to pay to the IRS after you sell this property. Now, I don't know about you, but $30,000 is a lot of money. For anybody, I think. Even if you're worth $1 billion, $30,000 is still significant. That's a pool in the backyard, almost. It's the pool, probably not the pavers, probably not the summer kitchen, certainly not the screened enclosure, but that'd get you a pool. Anyways, moving on. So how do we avoid paying this $30,000 tax hit to the IRS that's coming? That's where the 1031 exchange comes in. So there is what's called an intermediary, that is a group or company that basically holds the funds from point A to point B. But what you then have to do with it is buy more real estate. So if I do this whole thing, this $120,000 that I made from the property goes to my intermediary. And you can Google it. There's a bunch of them. I have an intermediary that I use and like that's local and is well funded and well backed. And I trust them to not run away with the money whenever I sell a rental property and do a 1031 exchange on it. So the money goes to the intermediary, And then what you have to do is you have 45 days to identify 3 replacement properties. And you can identify more than that, but it gets complicated. If you ever are going to actually do a 1031 exchange, call me, we'll talk through it. But you have to identify 3 properties in 45 days. And then after that 45 days, you have 135 days for a total of 180 days to actually buy one of the 3 properties that you identified. So your $120,000 goes to this intermediary. You have your 3 properties and you pick one of them. And then and technically I say 120,000, that was your profit. Really it's the whole amount, the whole $200,000 that goes to the intermediary. And then once you've identified and then contracted on and are ready to close a deal, you tell your intermediary to send the money over to the title company. They wire it over just as if nothing ever happened. You paid them a small fee and you avoid paying this $30,000 tax hit. And even if $30,000 didn't seem like a big deal, just to give an idea for what that means over time, and I actually ran my numbers earlier, I'm not sure why, but on 17,500, over 15 years at a 10% rate of return, $17,500 is actually, in 15 years time, $78,000. And so I can't do present value, future value calculations in my head, but I would think roughly that since $30,000 is twice that amount, it's going to be a minimum of twice the $78,000 and really probably more like 2.5 times if the numbers running in the back of my head are roughly correct. So all of that to say this, if you have a rental property that you are thinking about selling, before you just cash in your chips and take some big hit from the IRS, let's chat about the 1031 exchange option. It's a great strategy. It's above board. It's not a hack. It's not a trick. It's something that the IRS allows, and it's a great way to build wealth over time through real estate and not be taking huge tax hits every time you sell a property. So if you have any questions about it, feel free to give me a call, 904-405-1995. You can shoot me an email, jeff@era.com. And thank you for your time on a Friday morning. I hope you have a great weekend, and we'll catch up soon.